Hi, this is Randy Finney with Right Side of the Chart, and this is a market wrap for the week ending August 24th, 2018. What I'll do in this video is touch on the broad markets. I did a video this morning, an update, and there's really not a lot new to report, so I'll just breeze over the broad markets. I'll try to hit on most or all the active trade ideas since there aren't too many right now. Things are relatively light due to market conditions. Have a lot of inactive or unofficial trade ideas out there, but for now, what I'll do is hit on some of the trade ideas that are active on the site and anything else that stands out. I want to definitely do an update on gold, the US dollar, maybe oil, and any other standout trading ops. Start out here with Kane. And that also segues into something I wanted to talk about. I made mention in the trading room today that the benefits of diversification and asset allocation, whether you're an investor or a trader, an active trader, swing trading, trend trading. I believe that diversification is just as important in trading as it is in investing. And for those of you not familiar, diversification is don't put all your eggs in one basket. Now, what does that mean? Well, ideally, and it varies. A trader can have, I would think, as little as 8, but ideally 10 or more positions. If you can manage a dozen or so positions, that should be enough to give you proper diversification. But what's important is that if you have a dozen or more positions, that they're not concentrated in any one sector or even asset class. So diversification means different stocks within different sectors. At times, I'm often long and short. I'll own stocks, and on most points in time, I'm trading long and short because at any given time in the stock market, I don't care how bullish or bearish a trend is, there's always something going up and something going down. And I'm talking about trending. There's always some sector, niche subsector in the stock market that is going against the grain of the broad market. So that's why you'll always see a mix of long and short trades on the right side of the chart. As I often say, trade the market, trade individual stocks, not the market. It can be a lot easier, but I'll do both. I'll trade, I'll take shots on the index, but again, it won't be everything that I'm trading. And again, when you're trading the broad markets, I like to wait until those, everything lines up and you get the good buy signals, sell signals. Um, right now, I'm in a position I've been in for a while that if I could have gone back a couple of days, I wouldn't have taken it, but it hasn't stopped me out yet. And I'm talking about a short on the NASDAQ 100. So we'll get to those charts in a second. And again, the point here is diversify among different stocks, different sectors, or ETFs. That's a great way to diversify. But again, make sure you're in different sector ETFs and possible different asset classes. And what are asset classes? Well, you have stocks, which are equity ownership in a company. You have bonds, fixed income, commodities, and then even there a subsector, different types of commodities that oil, for example, agricultural commodities, gold, the precious metals fall under that category, and they all tend to also march to their own different drum beats. So Kane is in an active trade now. This one's underwater so far, but we haven't stopped out. We still have a stop on a daily close above below 649 or below 650. Any print 649 or lower, and it's just been pushing those limits lately, but hasn't taken us out yet. And I wanted to say I still like it. Like anything, you don't get married to it, and it shouldn't be, half or even a quarter of your portfolio. But I think it looks good. And there's some other ag commodities that certainly appear to be firming up and may make the case for a nice swing trade here. So this is sugar futures. I posted this in the trading room today. I just want to point this out. If you're in the Kane trade or any of the SG GFF, I believe, is the other sugar ETN. We have this downtrend line to watch, as well as a horizontal resistance level, minor resistance around 1043. So we'll call that 1045 to be safe. You have divergence down here. You have the indicators diverging, bullish divergence, that is, positive divergence. And so what we need to do is pop above the 1045-ish level there, and that would open the door. I'd like to see it happen next week. If not, there's a good chance this one can run the stop. And hey, if that's the case, we can always buy it back if it does. Or maybe I'll modify it, but I doubt I'm going to modify the trade stop on this one. We'll just watch it. Sugar needs to start firming up here soon. So that's a level to watch. And just like we had a downtrend line back here, A few weeks ago, we had a downtrend line and there was a pop and a nice rally. So I'm looking for a nice pop here. And again, the charts, when I go out, this is a 60-minute chart of the futures. I look out at the daily and the weekly charts and I see the case for a bottom. I see this at support. So I'm looking for and expecting more than just a pop and another new low in sugar. We'll see if it happens, but that's my outlook. And so if you really want to time an entry or an exit, or an entry, I should say, if you aren't in sugar yet and we're considering it or considering to add to a position, you want to see sugar futures break out above this level, and that might provide an objective entry or add-on. And continuing on my theme of asset allocation, we just went over sugar, which is a commodity, has absolutely nothing to do with the stock market. Here's another trade that we've had an active official trade for a while now. And even at the time of taking this trade or shortly thereafter, I made mention in one of the updates I recall that I didn't mind if this one traded sideways for a while. I didn't expect any type of explosive move in bonds, and that's what's happened. So you can see we broke out here. We entered this one all the way back on February 9th. So we've been in it for better part of the year. However, the beautiful thing about bonds, and I said at the time, is you get paid to wait. As long as this one's not going down and losing value, you're collecting a nice dividend. Those bonds pay interest. And as you can see here, I haven't updated this trade in a while, but here's last time I did an update was sometime, I guess, in June. And I showed you at that point we had collected 4 dividend payments, and you can see the dividends have been increasing about 16 cents, 17 cents, and these are monthly dividends, 19 cents, 20 cents. So there's a trend there. And at that point, we had collectively taken in about 73 cents in dividends, and we've had 2 more since then paid, and we'll have another one here in about a week or so. So let's just say conservatively, if I check the numbers, it's another 60 cents in dividends, which brings our cost basis down under 101 right now. Because if you have, we paid 102, that was our entry price. If you collect all those dividends, they just reduce off your cost basis. So cost basis down under 101. This one's almost at 103 now. So we've made nearly 2 points, which is almost about 2% on this one. Now, you might say, well, 2% is nothing. Number one, keep in mind that the point of bonds in a portfolio is to cushion the blows. If you're long the stock market, stocks drop, you usually see a flight to safety, especially in these type of bonds, government bonds. These are treasuries. And so you could see a nice pop. And they also don't have a direct correlation with stocks. They're a whole completely different asset class. And then finally, even if you're just swing trading this for profits and you're not as concerned about diversifying your portfolio, well, as I mentioned with this trade when we did it, it was recommended to go with an overweighted position. These are government bonds. You will not wake up to a 5 or 10% gap down like you can on any stock, including Apple, any stock out there. Earnings, news related, these are government bonds. So therefore, your downside risk is considerably less than stocks, and as such, you can take a much larger position size. So therefore, if you doubled your position size over what you might take in SPY, well, you're about a comparable 4% gain instead of a 2% gain. But again, not a get rich quick instrument, but just one that still looks good at this point in time. We still have the divergences in place. And again, we had TLT as a sister trade. TLT are also government bonds. These are the long-term bonds, 20 to 30-year government bonds. And TLT has been pushing up against that. We hit that second target back here. We've hit that level again numerous times. It's about 122.50. I had the first target set a little bit below there, but you can see a lot of reactions. So this is a nice big fat basing pattern. It's a trading range right here throughout most of the year so far, just like we had the trading range here, and we finally broke out above it and we rallied, and then we traded up in this range for a while, and now we're here. So if we break out again, it would only be natural to think that we now will enter another range up here, or at least run up to the top of that range at some point. So bottom line, I still like these, and again, it's just a small piece of the pie of an overall portfolio. It's a way to diversify. ITA, not much to report. This one is still active, short trade, and we haven't hit the stop yet. It's come close a few times. The stop on this one is a daily close above 208.50. I need to take out this downtrend line. I'm not crazy about it right now, but I don't see enough in the charts to pull the trade or to modify my trading plan. These are the Dow Jones U.S. Aerospace and Defense Index Fund. You have stocks like Boeing, Lockheed Martin, and the likes in here, and it's just been in one giant, very well-defined trading range as I just boxed in throughout the year. This is the beginning of the year, January, and so based on the long-term charts. I still think it goes lower. We've already broken. This is a multi-year trend line from early 2016. We broke it, back tested, and we've just been moving sideways. And I think this is largely a function of the stock market itself moving sideways. So if the stock market rolls over soon, then I think this one will plan out. If not, they take us out, and we can always re-enter it again if the charts confirm, if they hit our stop. There's KHC, also an active trade still. Steady Eddie, boring dividend paying stock. It has a nice yield, 4.25% dividend yield. And we hit the first target all the way back here, right after entering the trade. We hit that target. I guess we took it here on the break of this downtrend, and somewhere in here, I forget where exactly. So we already hit that first target, went about halfway up to the second target here, pulled back, and we've been consolidating. Not my favorite right now. If I didn't already own it, I wouldn't add it on as an active trade right now or take it. But there's some recent support right there around this level. I'll leave the stop as is for now, but like anything else, there's not a compelling reason to change the trading plan on this. If there was, I would close the trade early. I do that from time to time. I'll close out official trade that's early, modify the stop if there's something compelling, if something has changed in the charts. But I find it best if you have a trading plan, go in. And again, you're getting paid to wait pretty handsomely on this 4.25% dividend. So that's fine if it takes a while for us to get up here, excuse me, to T2. And it would also be prudent at this point, since we've already hit the first target, to maybe raise your stops above that level there. But I'll just leave that on because that's the original trade. And it does have still more potential to work its way up here to that third target. That's not the official or final target. It's just a potential third target. I don't have any intention to expand that or change it to the official target right now. We'll leave it at T2. SAFM, Sanderson Farms. This is a packaged foods company. We hit our first target today for whatever that was. I think about a 5.5% profit right there. Still looks good. I like it. Broke out, back tested, hit the first targets, been moving higher. And I had a sister trade to this I posted on, what was that? That was symbol PPC, I believe. Yeah, PPC, Pilgrim's Pride, another packaged food company. This was up nice at one point today, was up about 4%, but you can see broke out, back tested, strong bullish divergence. So the case for a bottoming trade here in that one as well. I didn't add it as an official trade. It'd just be a lot of overlap to the other trade, the SAFM, but I've updated this in quite a few videos. So there it is. Still looks good for now. And next up, Shop. This is a technology, this is a software application, and still like it. It was oversold recently, and tech is holding up in the broad market overall. We look at the 60-minute chart. We have had recently a divergent low put in on the 60-minute chart, and that's playing out so far for a little bit of a bounce. But I don't see enough in the charts to pull this trade. I'm just going to sit tight with this one and give it some room to play out. There's quite a bit of resistance up here if it does bounce any more than that. And again, it's all about this daily chart and the long-term charts. This is why this stock is shorted. Here we go. This is a nice clean chart showing a trend line back to early 2016, very well defined, a breakdown and a back test. This is why this one's still an active short trade on the site and why I'm going to give it some room. SRS, we just entered yesterday. This is a REIT ETF, short REIT ETF. I drew this bullish falling wedge on SRS so far, a little pullback today, nothing much, because that's a 2-time leverage, keep in mind. So this is the underlying sector, IYR, so it was up about 0.51 today. It still needs to take out this trend line, but the basis for this trade was this evening star doji right here. See that doji candlestick, followed by the green candle here, the doji, and the red candle. That's the doji, a bearish evening star pattern, and the divergent high as well, a negative divergence, which indicates a likely trend change, and also a failure so far right at the previous reaction high, which is resistance. That was also a divergent high. You can see what happened after that divergent high. And so hopefully we get the same thing here. That's IYR, which is again just the underlying, the non-leverage. I like to use the non-leverage ETFs for charting purposes more so than the leverage ones because you tend to have decay even with SRS. And then finally, as far as the active trade ideas, XLY, I still like it. I had an inquiry about this today. You had a well-defined uptrend line breakdown. Now all we're doing is back testing, so I can extend that trend line, which I've done here. I can extend the divergence line. Now it's the uptrend line's more important. This is the trend it's following. Divergence lines are just merely showing the divergence. If we move higher, that line moves up. It's not as important as a trend line. This trend line contains price, and you can, yes, this technically contain these reactions up here, but when drawing divergences, I'm more concerned with the uptrend line here, and I just wanted to point out that these divergences are still very much intact on XLY, and for XLY to start playing out, we need to see, or really will help to see Amazon break down because this is the largest component of XLY. It makes up a whopping 1/4 of the returns of that consumer discretionary ETF. And you can see a very well-defined trend line. It's diverging, pinching up within this wedge. We need to break that trend line, and if Amazon does and pulls back and comes back in, XLY will almost certainly follow suit. Okay, now the stock market's been a snoozer lately, but what's been exciting is gold. We had that relentless sell-off in gold, followed by a heck of a turnaround so far. And all along, I was looking at this scenario, laying out this scenario, what I called a bear trap scenario in the euro US dollar pair of a break of this well-defined support level. That has happened, and we've recovered it now. So, there's several parts to this, as I mentioned recently. Number one, to see the breakdown in an impulsive, convincing move. Number two, to see a recovery, recouped 100% of the breakdown so far. We're back above that key support level, which is was resistance when we were down below it. Now it's support again. And the next bullish event would be to see this downtrend line taken out. So still a little more work to be done, but so far so good. And again, it's these big divergences here that tell me that this can have longer term bullish implications on the euro, which means bearish implications on the dollar. If this plays out, I went over recent videos. My bias right now, I feel strong that non-U.S. markets are set to outperform the U.S. markets going forward, and that's on a relative basis. Please keep that in mind. Please understand when they talk about relative performance. Let's just say there's a sharp correction in the global equity markets. Let's say the U.S. drops. So if the U.S. drops 10%, and the overseas markets that I highlighted the other day on average drop 5%. That's still relative outperformance. Both can go down, but I do believe there's a mean reversion coming. We haven't seen this disparity. I don't believe ever in between U.S. markets and international markets, and I'm referring to developed countries. Again, I did that video a few days ago. Europe and Asian markets I'm most bullish on right now, and that is, let's just show you one of the ETFs that I was looking at. There's quite a few out there, but they had this one here. If I can dig down on my list off the screen. CWI, like CWI, you can kill two birds in one, or several birds in one stone. It was up about 8.84 today. This has it's the MSCI ACWI ex-US ETF. So in other words, it has all those countries I mentioned, European, Asian countries, including China. There's some other ones out there that some have China, some don't. And again, you can also do those countries individually. And I like countries like Russia look good. That was up 2.68 today. I mentioned RSX. China, I mentioned liking, and there it is, up another 1.4%, 1.5% today, testing this wedge. So that's where I think there's more opportunity right now than the U.S. market. So that's you haven't added that as an official trade idea. The entry wasn't really, there wasn't really a sharp entry there. And I may throw that on out there maybe over the weekend or on Monday, add CWI or some of the other ones on as trade ideas. But again, if I didn't like them, I wouldn't share them. Oh, and of course, this hinges largely, as I did in that video, I showed you overlay of the euro and that CWI ETF, and it's the correlation is unmistakable, especially particularly with the European markets, of course. Okay, moving on. Oil, always got a lot of inquiries on crude oil, and I also tend to trade that one quite a bit. We had this big divergent high, so I think the longer term outlook remains bearish on crude, but really not positioning that way. I'm just, this has been a great swing trading vehicle. It's getting, crude looks toppy up here, and it's been chopping around some big directional, fairly clear directional trends. In other words, tradable trends. This is just a daily chart, but you can see these trends. I'll just hit them with the arrows here. Uptrend, downtrend, uptrend, downtrend, uptrend, downtrend. So you trade this. If you trade CL, let's jump over to that crude futures. And this is a 60-minute chart of CL crude futures. I posted this chart in the trading room this morning, mentioning this as a trading op, and I took a short on this one right here. I had drawn this line. I had an uptrend line here. This divergent high, so what I highlighted there, I hadn't added the lines on this particular chart. There it is. There's your negative divergence right at resistance. You can see I had two resistance levels here at 69.20 and then 69.52. Mentioned it could be a short here all the way up to that level. You could short it, and it reversed about over almost 1.5% reverse off the top. So that's not bad for trading CL. You can get quite a few pennies in your pocket for even a 1% move in crude for each contract. So there it is, and I think there's more downside to come next week. So I think because again, that divergent high, that's just been my MO lately on crude oil. Just wait patiently. Somebody asked me my opinion yesterday when we were down here, and I didn't have much of an opinion, much of a direction on crude because we didn't have these. Now that we had the divergences, there it is. That's the next setup right there. We break this trend line with conviction, we're probably going quite a bit lower. And again, you can see the trends here. This chart doesn't have every divergent high and low marked up, nor all the trend lines. I've covered these in the past, but what happens? Future contracts keep rolling. These are the October, so every time I have to start a new chart and redo the trend lines. And on a somewhat related note, natural gas. I also posted this one in the trading room today as a trading op. Mentioned I shorted natural gas as well. What I saw here was a break below this bearish rising wedge pattern, pretty well-defined trend line, impulsive breakdown as you can see there, and of course confirmed with negative divergence. So that looks like just like we had positive divergence down here at the lows. When this trend line was broken, that triggered that uptrend. So there it is. Wash, rinse, repeat. Pretty simple yet effective stuff. I don't mean to oversimplify it, but that's pretty much it. Divergent high, breakdown, back test, another back test, and then the downtrend. Divergent low, uptrend. Divergent high, hopefully a downtrend. So that's nat gas futures. Now this is a continuous contract. If you trade futures, you know what I'm talking about. I took today the continuous are the Septembers. I took the Octobers because these are about to roll over into the next month. And I might be in the trade for more than just a few days, depending on how things play. There it is. So if some of you did the same, then you'll notice there's a difference. When you trade futures, the charts don't always align, and so in this case, we're already right now at support, and it's a pretty well-defined support. Normally, this is where I'd probably cover, but I didn't take a very big position. If I did a day trade position, I would have covered at least a good chunk of it there, if not all, and then waited for a breakdown. But I'm going to hold out. I took a starter swing position, and I just wanted to make mention that's where nat gas is right now at that support right there. It's about I had the line at $2.90.5, so 2.905, and right now that's at 2.904. So we get a break of that. This is my point. We'll probably continue much lower, but you might get a reaction there first because that's the first tag of support since back here. There's a couple other tags there. And for those of you that don't trade futures, there's a lot of proxies out there. Here's a leveraged 3-time long leveraged. You can short this one. This is UGAS, or you go with DGAS, which is inverse. You can see UGAS is at support, trendline support now. If that breaks, which I suspect, as well as horizontal support, I should put another line there. This aligns with this support I just showed you on the futures. So there it is. Need to break pretty much where we closed today, and if so, I think we drop here. That'd be better than a 6, almost a 7% drop down to that 59.81 level. And to reverse it, DGAS, I haven't marked this chart up. There it is. This is DGAS, the inverse one you could buy there. And there's your downtrend line. See, these don't track. There's a lot of decay in these. Oh, well, no, actually it does. It lines up pretty perfectly, almost perfectly with that those reactions there. So there it is. Same story. You have some resistance. So this one you need to pop above there, and I think it can run all the way up here to about 23.57, at least, possibly more. And that would be, what is that? About 9. Yeah, I guess I understated it before. That'd be about a 9% pop up to that level. Okay, and we'll just wrap up with the broad markets here real quick. Again, I did a video this morning, and not a whole lot has changed. I know the market's trying to. I didn't even watch today whether it made that new high or not. I haven't even checked the headlines if we closed above the January high on the S&P 500. Either way, we're close enough. 6 to 1 half dozen or another. It doesn't really matter. I mean, for the TV, they're going to cheer it if you get it. But here's the thing: we have this. We continue to diverge, and yes, these are divergences, and no, it's not that they didn't play out. Each one played out for its own correction: divergent high correction, divergent high correction, divergent high, little one, little wedge there, little correction. So this is it. We simply have an extension of the divergences. This trend line, it's not super well defined, but I think it's worth watching on SPY at this point in time. Or ES, I'm sorry, I'll get to SPY in a second for you SPY traders. There's ES. So as I said, I think any new high in the S&P 500, even though there could be a couple percentage points more to the upside, I think it will fail soon and we'll have a decent pullback. When I say decent, I'm probably talking 5% or more in the S&P 500 as well as the NASDAQ. So let me get to the NASDAQ futures. Let's see. Okay, here they are. This is NQ, the Nasdaq 100 E-minis, and so you can see. And I also posted an update in the trading room today. And with I think it was I think I used QQQ. Same story really. These are the futures, and you can look at QQQ. So what we did is essentially made an equal high to the previous high, and I'm referring to right here from early August. We had a reaction high there. We matched that reaction high, so that's equal highs, while the indicators are making lower highs, so i.e. negative divergence. There's the PPO down here at the bottom, RSI. Now, there's certainly the room, just like on the S&P 500 ES, to push up a little more and then reverse, and I think we'll do it. There's an even better defined uptrend line to watch on NQ. So if you're an NQ trader and you want to wait for a sell signal, wait for this trend line to go, all the better if that trend line on the ES goes as well, or the S&P 500. So let's get to those charts and SPY real quick for you SPY traders or those that track this. There it is, divergent high back here, another divergent high. Same story on the ES chart. It's going to look the same. It's the same thing. It just doesn't trade around the clock like ES. But you have these series of divergent highs and series of corrections. Watch, rinse, repeat stuff. Divergent lows go long, divergent highs short, especially with a sell signal. So we could probably. I don't have a really solid trend line. I know that's the arrow tool. Just imagine that's a line tool. Again, watch that one on the ES. It's a little bit better defined, but the point is we have this divergent high here as the S&P goes on to try to make new highs, new record all-time highs. But again, I think they'll be short-lived. But we don't have any sell signals yet, so just something to watch. Maybe we don't get a trend line break. Maybe it comes in the form of some type of candlestick reversal. And again, we can continue to push a little higher now, so you just have to be patient if you're looking to catch the next short, or if you're long and you want to continue to ride this up until you have evidence of a sell signal, that's fine. Maybe you get some type of bearish candlestick reversal pattern. I just don't have a good trend line or really any good horizontal support levels to watch. I'll give you one right now, actually, a minor level. I can see some reactions back here and here. 285.65. Let's just say we break that. I think the party will get started and for a move back down here at about that 279.45 level at least. Finally, QQQ. It's going to look just like the NQ chart I just showed you. There's that equal high from the earlier in the month right there, previous high. Actually, you can see we have almost this on this 60-minute chart, a triple top so far. Now we haven't reversed yet. And again, we might pop higher, and it probably, you know what, it wouldn't surprise them if we did pop a little higher on Monday. But there's that minor uptrend line I was pointing out. There's a more significant trend line, and to really, if you didn't catch the video today, you have to jump out to the daily chart, and there it is. That trend line comes off the early April lows, well-defined trend line, big rising wedge. And again, my expectation is minimal upside in the Qs before we get a breakdown of this trend line here, the yellow minor trend line, and then we'll probably come in and visit this all-important longer-term trend line that goes from mid-2015 and possibly more. I still think at some point in 2018 we'll probably come back and retest these lows from January and February. So for now, that's it. The markets are on autopilot. It's a slow grind up. It's not a runaway melt up or anything like that. So I think we might get a trading up here soon on the broad markets. And right now, just again, focus on those individual items, individual stocks, sectors, ETFs, commodities, because that's where I think there's better opportunity, as well as international stocks if you're a long side only trader. This has been Randy Finney with Right Side of the Chart. I hope you enjoyed it, and